Good morning, ladies and gentlemen. Welcome to this SASFIN June 2020 results presentation. Thank you for your interest in our share. Let me say that the year to June 2020 was a tough one. There's no doubt about that. In the 9 months to the end of March, we were actually doing quite well, even though the economy was already showing signs of lagging. But at that point, we were making good progress on two of our key ratios, that is the cost to income ratio and the return on equity. However, in the last quarter, things changed. COVID-19 certainly impacted on our sales. This was partly also because we brought in stricter credit policies in the uncertain environment. We also experienced higher impairments on our book as our clients began to feel the pressure of the lockdown, and one of the government issues of stock also experienced difficulties. And the private equity valuations were also impacted. But on a positive note, I want to congratulate Michael and the team for looking after the safety of our staff and our clients. And I think the fact that we still maintain such a high level of service, despite the fact that most of the staff were working from home, is a great achievement. And I think we were rewarded for our serious expenditure on IT in previous years. I'm also very pleased with the strong capital and liquidity position of the group. Let me close by saying, I hope that government, business and labour will now get together, grasp the nettle and put South Africa back on the growth path. Our economy needs growth, we need jobs. And I think COVID-19 has taught us that we can show resolve when our back is against the wall. For those few brief comments, let me say to you, I trust you'll enjoy this presentation today. I'm certainly looking forward to it. And let me now hand over to Angela, who will take you through the numbers. Thank you.
Thank you, Chair. Good morning, and thank you to everyone for joining us today. Before we go through the financial numbers, I'd like to just talk through some of the restatements in our annual results. We disclosed in the first half of the year that the group adopted IFRS 16, the restatement of leases, with effect from 1 July 2019 without restating comparatives. For the full year's results, we have restated our comparatives in order to correct and enhance the disclosure on the face of our income statement and balance sheet relating to IFRS 9 and IAS 1. These restatements had no impact on our earnings, our total assets, total liabilities, or key financial ratios, but relate primarily to, upon transition of IFRS 9, we continue to recognize a portion of a loan in amortized cost that should have been recorded under fair value through profit and loss. Since the carrying amount of this asset equated to its fair value, the correction from amortized cost into fair value did not have an impact on our balance sheet as well as our earnings. In addition, on the income statement, certain line items which were previously disclosed either in other income or commission income should have been disclosed as gains and losses on financial instruments. Again, these corrections did not change the overall non-interest income line on the income statement as well as our earnings or key ratios. Thank you. Our results for the full year to June 2020 is reflective of a business with a strong capital and liquidity position, but negatively impacted by a very difficult operating environment as a result of the COVID-19 pandemic. The group posted a headline earnings loss of 48 million against a profit of 161 million in the prior year, down 130%. This is due to increased credit impairment and a decline in our private equity provisions, investments attributable to a weak economy. The total income declined by 6.37%. The capital pillar, where we have our private equity valuations, were negatively impacted by lower forecasted cash flows, taking into account the impact of COVID. The banking pillar has seen lower volumes across the business and non-interest income has dropped. This is despite the overall group seeing an increase in the net interest income of 1.41%. This is despite a decline in our loans and advances book. The wealth pillar has remained resilient with an increase in 3.7% increase in income driven off foreign and asset management income. Our credit charge has increased by 214% year on year, resulting in our credit loss ratio almost tripling from 102 bips last year to 303 bips in the current year. This is due to the deterioration in our arrears book, as well as the impact of the forward-looking overlays, which takes into consideration the macroeconomic variables impacted by COVID-19. Further, a detailed assessment was performed on our holdings of government-related negotiable instruments, and provisions were raised against these investments in line with IFRS 9. Our costs have been well contained, with operating expenses increasing by 0.49%. Non-cash items up 70%, and this would relate to depreciation arising from our adoption of IFRS 16, amortization of intangibles, as well as the impairment of intangibles, where on an annual basis we do an impairment test on all our intangibles to determine right of use. Lower income, as well as the muted expense growth, contributed to the cost-to-income ratio increasing to 82.2% from 76.59% in the prior year. We took a very conservative approach on our assessment of assessed losses. As a result, we did not account for some deferred tax assets, resulting in our effective tax rates being 4.08% in the current year. On our financial and capital position, we have a strong cash position. Our customer deposits have increased by 3.17% to 5.1 billion, and our long-term funding has rolled off by 25% in line with its contractual maturities. Our net available cash has increased to 2.3 billion, which is as a result of the decline in the loan and advances. Our LCR is well above the regulatory minimum. The gross loans and advances are down by 9.35%, where we have seen a tightening of the credit in the second half of the year, given the macroeconomic environment. There's been reduced volumes and utilization limits in our loans and advances book. Our CAR is improved to 16.9% of 15.6% in the prior year, due to a reduction in our risk-weighted assets as well as prior appropriations. This is a summary of our ECL on amortized loans and advances. The profile of our book has remained consistent year on year. However, the ECL in stage 1 has increased due to the impact of the forward-looking overlays, and there's a portion of that sitting in our stage 2 ECL as well, resulting in our coverage ratios increasing in those two stages year on year. Our coverage ratio in stage 3 has increased, and this is due to a change in mix in our exposure in stage 3 year on year. In the prior year, we had a large exposure with a small ECL due to the nature of the exposure, which was fully recovered in the current year. In the current year, however, we've seen an increase in arrears in a more granular book where the ECL is model-driven. This has resulted in the coverage ratio in stage 3 increasing from 44% in the last year to 56% in the current year. The headline earnings profile for the last 5 years. Historically, our H2 performance has either been on par or slightly better than our H1 performance. And given the drag effect of the increased impairments, as well as the valuation adjustments on our private equity portfolio, we then see the loss in H2, resulting in the overall earnings loss of 48 million in the current year. In summary, the movements of our headline earnings is really as a result of the decline in our income driven off the back of the private equity valuations. The impairment charge, and included in that charge is both our ECL on amortized loans as well as our ECL on government-related securities. And then we have our non-cash expense items, which have increased as a result of the adoption of IFRS 16 and our amortization of intangibles and goodwill. Key features, and in summary, our financial performance indicators are negatively impacted as a result of the losses incurred during the year. Our balance sheet is positive on the deposit growth and core funding, and our credit quality has been negatively impacted due to the increase in impairments, which has impacted our credit loss ratio, our coverage ratio as well. Our capital adequacy ratio is well above the regulatory minimum. Our total assets under management has seen a record growth in the current year, which is up 18.21% year on year. As previously mentioned, the decline in our total assets is as a result of the decline in our net loans and advances book, which is down 11.87%. Despite the increase in our cash and negotiable instruments, as also mentioned, we do have an impairment against our government and land bank exposures that sit in that line. Our intangible assets, we have over the last few years invested in IT and technology on key systems that have gone live during the last 2 financial years. And that decline year on year is as a result of the amortization as our lines of business systems have gone live, as well as our annual impairment tests which we have performed. Included in our non-current assets as well as property, plant and equipment, that increase of 26.86% is as a result of the addition of right of use assets as a result of IFRS 16. On our financial position and liabilities, I've gone through most of the major line items on the slide, only to mention that we have the addition of the lease liabilities arising from IFRS 16. And at the bottom of the slide where there's the non-controlling interest, we de-recognized HRS, which was a subsidiary in our capital pillar, which is now recorded as an investment. On the financial performance, we have discussed most of the lines here. Our total income is up by the 6.37%. Our impairment charge, you can see, is a major drag on our performance, which is up by 214%. We have maintained our cost growth, which has been largely flat year on year, but driven really of non-cash related expenses. Our income tax expense, in terms of the effective tax rate, is at 1.8 million, driven off assessed losses which were not recognized during the course of the year. We have seen an increase in our cost to income ratio, and we believe that we are doing the right things in managing our cost lines and have further initiatives in place to further optimize our cost base. As our revenue normalizes, we do believe and expect that our cost to income ratio will come back to previous levels. The gross amortized loans and advances and credit risk. Since the adoption of IFRS 9 in 2018, we have seen an increase in our coverage ratio from 3.62 to the current 7.96%. And this is due to the forward-looking overlays and the impact that that has on our stage 1 impairments. Our core funding base, our long-term loans have come down in line with the credit profile, and our deposits from customers has increased by 3% year on year, resulting in an overall increase in our core funding to 1.5%. Michael will discuss in later slides detail around future initiatives in terms of our core funding. Cash and negotiable instruments As mentioned, our cash and negotiable instruments has been impacted by the impairment on our government-related securities. Having said that, we have seen an increase in that line year on year. In terms of our LCR, we have not taken the land bank exposure into account in determining our LCR, given the fact that it no longer qualifies as high quality liquid assets. Having said that, our LCR remains well above the regulatory minimum. On our capital adequacy, we see an increase year on year, and given to 16.9%. Given the loss in the current year and the guidance provided by the PA, the group has not declared a final ordinary dividend, nor have we declared a preference dividend for the year. Thank you. Before I hand over to Francois, who will take us through the capital pillar, in summary, our performance for the year is really driven off three major factors. In the capital pillar, we've seen the impact of the private equity valuations. The wealth pillar has seen good earnings performance driven by increased revenue as well as flat cost growth. And in the bank pillar has significantly declined due to the operating profits going down by the impairment line, which is the major contributor to that performance. Thank you, and I'll hand over to Francois.
Thank you, Angela. Good morning, everyone. So within the capital pillar, obviously, you would have seen the number on the previous slide. There was a loss of 72 million rand, which is obviously a very disappointing result, but it really was a case of a tale of two businesses within the capital pillar this year. And let's start with the bad, was really on the private equity side. Well, and it was the bad in that obviously, I mean, because of the impact of COVID on our investee businesses, we were, and I think quite justifiably, have been very conservative, in particular on the cash flow forecasting in those businesses, and then the discount rates. The good news over there is that, I mean, in most of those, or in all of the, barring one exception, all of those losses or mark-to-markets, negative mark-to-markets, are obviously of a non-cash nature, and we do believe that our portfolio remains conservatively valued. In terms of a strategic decision we made about 2 years ago, the decision was made to not make any fresh deployments within the private equity business, and to rather focus on building out our specialized lending business across our property and business lending franchises. I'll talk about that in a bit more detail later, but let me discuss the private equity portfolio and some of the developments within that business. So within that business, the portfolio is, as we've said, we think conservatively valued, and we have been gradually disposing of assets within that portfolio. During the 2020 financial year, we exited, or had the contractual commitment to exit at year end, circa 80 million rand worth of private equity assets. All of those assets we exited at or above carrying value. Then on top of that, we are in quite advanced discussions on about 120 million rand worth of other assets within that broader portfolio that we are looking to exit. Just to be clear on that though, we've got some really good businesses within the portfolio, and we are managing those assets in terms of maximizing value, and some of them right now are not at the point in their life cycle to exit, whereas others are in a much more appropriate point in time. So we are managing that quite circumspectly, and we remain confident that we've been very conservative in our valuations. So that really addresses the private equity portfolio. To mention that when we get to the financial slide, you will see our impairment number there looks a bit out of kilter. The reason for that is that we did experience one business failure within our private equity portfolio. We had already written off all of the equity in this particular investment as at the end of December, as at December 2019. However, the business then during the lockdown went into terminal decline, and we declined a follow-on investment into the business as we did not believe that it would be viable post-COVID. And I'll explain that in a bit more detail when we discuss the impairment line in the income statement. Now, on the positive side, in terms of that strategic shift we made 2 years ago, where we focused those attentions has really been within our specialized lending franchise across business lending and property lending. And there it really is a good news story. We've originated in that business, and that was pretty much all before COVID, about 400 million rands worth of credit assets. 300 million was deployed within the financial year, or within the 9 months preceding COVID, and 100 million remains. We are in the process of, it's just a big chunk of that is a property deal where we're just waiting for bond registrations, and we will then deploy on that deal. The pipeline in that particular business is looking strong. We remain very confident about the potential in that business, and I think and Angelo and the chairman touched on this, but we did for very obvious reasons scale back a bit in our lending activity during COVID, just in terms of taking a wait and see approach. So that has delayed some of the, let's call it the run up of the potential, the loans and advances book in that business. However, based on what we're seeing at the moment, it still looks very positive in that business. Moving on to the next slide. As I mentioned, and you can see there in the total income line, the huge swing in the private equity valuations, and that's our private equity and property equity valuations. Those of you who know the portfolio will know that it comprises roughly 1/3 property equity type transactions and 2/3 private equity type transactions. And across those two asset classes, obviously there's been a negative impact on the valuations within those particular businesses. That said, just to reiterate the point that we still believe in the quality of the underlying portfolio, and we trust that this is a temporary setback, and as things normalize post-COVID, that we should see an uptick over there. I did touch on if you look at the impairment line, that really is a function of a loan we had into this investee business of ours, and that accounts for more than 50% of that impairment impact. Then the one other point Angela touched on is we had a partial exit of our investment in a short-term insurance broking business, and the so-called strategic investments. And the result of the strategic investments, and it does go a little bit to the heart of the cost to income discussion, is that business and our other strategic investments all operate at very high cost to income ratios, which does skew the group's cost to income ratio on the whole. So with HRS now being the short-term insurance broking business being exited, that will also have a dramatic impact on the cost to income ratio within the pillar, and then it will have a knock-on impact for the group. The other point, and Angela also touched on it, if you look at the tax line, you would have anticipated a tax credit at the bottom line because of the losses sustained within the pillar. However, because of a very conservative approach on the deferred tax assets within the group, we've decided to, for the time being, not recognize some of those deferred tax assets. However, we are quite confident that we should be able to use all of it in the fullness of time or over the short to medium term, but we felt it more appropriate to take a conservative approach at this juncture. As I said in the intro of this discussion, the real focus in our business and where we have a very scalable and client-centric solution is around our specialized lending product. We are seeing a very real demand for more bespoke financial solutions that are more akin to debt in terms of how we assess them, in terms of how we solution it for the client. And what we are seeing there is that there's a very real need for that niche within the South African market. And in fact, in that sense, COVID has been frankly a boon in that regard, and we are seeing a dramatic uptick in inquiries within that business. The group further made a decision that within our lending activities to integrate all of the business lending, so obviously excluding the asset finance activities, but where it relates to business lending into a single business lending pillar, which is for the time being will remain being known as SASFIN Capital. So that ostensibly includes our trade and data finance business. The benefits of combining these businesses is that obviously it results in a more coherent and sales strategy across the client mix. It also has the benefit of achieving scale operational synergies in that system. A quick example is that we are looking at consolidating a line of business system in that business, which we anticipate resulting in an annual cash cost saving of about 2 to 3 million rand. So there are some very real benefits in combining these businesses. That by and large will be the focus for the year within the capital pillar. And that concludes my remarks.
Thank you, Francois. Moving on to the wealth pillar. Within SASFIN Wealth, we really offer a broad range of solutions and services within the wealth and investment space, and we do this both directly as well as through some strategic investments that we have. I've broken it down here into the 4 categories. Firstly, investment management. This is a strong focus of ours, and we provide solutions both into the institutional market through our collective investment schemes as an asset manager, but also to private clients. And very much our focus over the years has been in providing truly global solutions. So, a decision was made probably about a decade ago to really make a concerted effort in moving us into offshore markets, into more global solutions, and giving our clients a more diversified geographic footprint in terms of their investments. It's been a very strong growth story for us in the investment management space, both in terms of offshore as well as the asset management. And we're currently in the process of launching a private markets offering, which we intend starting with a private equity fund. We're not in this business to win awards. We're in this business to serve our clients. But over the years, we have won quite a few awards rather, and I'll get into more of that later. Linked quite close to this is advisory services. Just to say that our advisory services are independent of any of our other businesses. They, in terms of our governance structures, the way these businesses are set up, and in different entities, and in different financial service provider and phase licenses, they do act independently, and we do provide advice through across a broad range of products, both within the private client as well as the institutional space. So that includes the wealth advisory services to private clients. Closely linked to this are the investment services and fiduciary services that we spoke about launching about a year ago. And then healthcare services and asset consulting within the institutional market. To say within the healthcare, it's both in terms of direct clients as well as corporate clients that we service in that space. We do also have transactional businesses. Our main transactional activities are stockbroking for mostly private clients and corporates, both locally as well as offshore. And then we have a strong fixed income franchise servicing institutional clients with niche products and solutions. Furthermore, we have strategic investments in both the Efficient Group as well as DMA. DMA is the old Saxo South Africa that we bought with management. We hold a non-controlling stake in that business, with management holding the controlling stake, and we're now probably about 18 months, I think, into concluding that that transaction. Actually, sorry, it's been longer than that. Time really does fly. Been a great deal for us, a great investment, and we really do enjoy working with that management team. And then on Efficient Group, we went through quite an extensive process in the last financial year of assisting the group to delist, and us remaining as a shareholder through SASFIN Wealth. Subsequent to that, we did receive a non-solicited offer for the shares. We are still under cautionary. That cautionary has been renewed this morning, and we will continue to give an update as this progresses. Negotiations are ongoing. Just looking at the financials, we saw growth in our income during this year. This was really driven by the institutional asset management efforts as well as foreign revenue, pretty much in line with asset growth in those areas. Certainly was an offset. We have seen some pressure on revenue linked, especially to local JSE equities. So both in terms of brokerage as well as the other fees that we earn on those assets, the pressure on the market has put some pressure on those assets. But also just to say that, as we continue to expand the global solutions that we offer to our clients, from being not just equity but really multi-asset and multi-strategy solutions, we've seen clients taking a larger portion of their investments offshore. So really, part of that mix is also the pressure on local is our clients embracing being truly global investors. Costs very much kept them flat over the year. We've really tried to be exceptionally prudent in this environment, understanding the broader pressures on the economy and the business. And then, we did see some benefits from our associates, from our strategic investments on the tax line. All in all, this has resulted in positive jaws for our business, giving us a nice pickup in our operating profit for the year. Just to say that, total assets under management and advice for the year up about 18.5%. And our offshore assets now make up 35% of our total assets under management. Just sticking with assets, this just shows the trend of our assets under management and advice. Just to say that over and above this, we do also offer deal and execution and other administration services on assets of in excess of 50 billion that take the total assets over 100 billion. But you can see the growth there. Big growth in institutional, being our collective investment schemes as well as offshore, and offset to some extent by some pressure on the local JSE assets. Very importantly in this space is that this has really been driven by a number of factors. We've seen very strong net inflows into those businesses where we're focused, be the global solutions and institutional. It's been supported by solid performance within those solutions, but obviously the rand has also played some part in terms of those offshore assets. I've spoken to local markets remaining under pressure, but just to say that we in this space are completely aligned to our clients. I think very important is that the more diversified and global, and I mean across sort of geographies as well as asset classes, our investment solutions are, and the better they provide to the needs of our clients and perform as they should, the better for our business and better for all stakeholders. So the nature of this business really is one of the interest of our clients being very much aligned to the interest of all other stakeholders. Just looking at some of the highlights of the year, I've already spoken to offshore as well as institutional. Just to say again, we really have seen strong performance across most of our solutions, and a few more awards coming through this year in terms of Raging Bulls for the BCI Flexible Income Fund. We also got a Morningstar Award for the BCI Balance Fund, and we continue to, across most products, play in the top quartile or 90th percentile of that space. I've spoken about the fiduciary offering as well as DMA, and just recently, I think it was last week, I think, we won the Best Advice Award at the Stockbroker Awards 2020, so the Intellidex Top Stockbroker Awards. It really does talk to what we do as a business. We are a high-touch business looking to service our clients very closely. It is our legacy. It's where we come from, and to be recognized by the industry as well as our clients in the space is very welcoming. And just to say that a very large portion of determining this award was the input by our clients. So, linked to this was the People's Choice Awards, where we got a top 3, and one of our in-house stockbrokers, Helen Hayworth, came in the top 3 of stockbrokers in the entire country. So really a very welcome recognition by the industry and our clients for the efforts that we've been making through the year. The challenges remain weak local conditions, and you can see that flowing through in terms of local broader market performance and the pressure on revenues in that space. So that continues to happen, and that includes the brokerage or transactional revenue that I was talking to. But once again, the nature of our solutions, diversifying our clients' exposure internationally, really does reduce their risk and aligns us to our clients quite well. Our focus is in 2021. I say this every year, and I've said it every year since I've been at SASFIN at these results presentations. Number one for us is around people. We are a people business. And everything we do is based around relationships. So our key focus remains on attracting and retaining the top talent in the industry, which we've been very successful at doing. We've put a massive effort behind our distribution efforts, and we're going to continue to do so. We've got some fantastic solutions that are being embraced by the market, and we really want to put some more score on the board in terms of that. I think, global in terms of giving our clients truly global solutions and expanding that offering is very important to us. But we're not only focused on global, we have quite a few initiatives going on locally as well. I spoke to the private markets offering, and we've been expanding our product range with the institutional space locally in the last year. Our financial advisory services, adding on fiduciary, was really about making our total advice more holistic. And this is not just about local advice or structuring or estate planning, but really taking this into the global sphere as well, where we are entering into joint ventures and strategic partnerships with global players, so that we can offer our clients sort of the best advice across these areas. And then we remain client-centric. I think this is really important to us, and it's about technology, it's about process, it's about solutions, it's about everything. And then working very closely with our strategic partners. We've had a very close and good working relationship with our strategic partners, and we intend continuing with this. Thank you. That's all from me. I'll now hand over to Linda on asset finance.
Okay, good morning, everybody, and I hope everybody is keeping safe and trying to be positive in these very difficult circumstances. So asset finance, we provide asset finance on a variety of different assets and across the entire South African economy. We positioned in a point that we are very client-centric, like Errol was saying. It's all about the client and our service levels and ensuring that we give we have the right relationship and have the right speed and support for our clients across the industry. What's happened, I think, with COVID, it's made us reposition ourselves, even though we were forward-looking in terms of what's happening in the market, in terms of the fourth industrial revolution. And what's happened, it's made us have to relook, because a lot of companies now are working from home, and also living to our values, to look at supporting companies to become more energy efficient and environmentally friendly and doing the right thing. And COVID has made us relook in terms of just doing normal asset finances. How do we be more? How do we be more to the market? How do we support our clients? And not only how do we support our clients, how do we support our country and our environments and doing things correctly from a social aspect? So, and we are absolutely geared to be able to do this. I'm going to start with our challenges this year. Our results, unfortunately, don't show the progress and the effort that we've made in the asset finance division. Up until February this year, we were ahead of budget, we were tracking, we were looking at different products, and then obviously COVID hit. So the reduction in our book, we were tracking our book, and then we had a reduction in our book with April and May being very weak months, and with a beautiful recovery in June. But because our book amortizes so fast, our loans and advances declined in the last quarter of the year. The biggest impact from a new business perspective, we achieved 94% of budget, even though we had the difficult 3 months, was an increase in our impairments. That was a combination of obviously companies struggling in these difficult times, but also with a new forward-looking model that was applied, we took a very conservative view. We also, what's quite impacted that hasn't come out in these numbers is that there were a lot of clients that came to us for support and assistance. And we did in the region in asset finance between 600 million of payment holidays, which obviously, if you do a payment holiday, it impacts your stage 2 impairments. And we felt that we needed to stand by our clients, and especially industries that were impacted by COVID, that we needed to support them and extend their payment terms and try and get them through this difficult time, even though it has quite an impact on our overall impairments. Credit, in terms of going forward, we've always had a conservative credit view, but we had to relook at how we do credit and assist clients with their cash flow, but also see the affordability of how they can service their debt going forward. In the past, we would have a view, probably more of a view, if we've got an existing client, he's been on our books for a long time, we would take a view and been able to assist him with his credit. Now we've got to see, how do we assist clients, support them, move them forward, and look at their affordability, which obviously has an impact on our overall credit appetite. The highlights, why I started with the challenges, because there's been a lot of highlights during this time. And one of the things was working with our clients. We have relationships with our clients that go back 20 years. And just the way the collaboration that we've had with our clients, and the support and the loyalty, and how we've worked hand in hand, has been absolutely incredible. And we've always been client-centric, and we've always worked closely with our clients. But you only really see true relationships in difficult times, and it's been amazing. So I have to thank our clients in this, because they've stood by us. And although we had April and May were very difficult, we recovered in June, and we've seen an increase in business. And although our credit policy has got a little bit more conservative, we're working hand in hand with our supplier base and our clients in order to not only get our business through, but to get their businesses through and our end user businesses through. So it's been actually quite an amazing experience. We've also been able to diversify some of our products, and we've launched pre-discounting vendor finance in order to finance assets prior to them moving into the asset finance rental or lease or installment sale. We've invested this year a lot in our capital equipment division. And particularly in these times when you've seen an increase of SMMEs and companies needing to diversify, they need a bank and a team of people behind them that can help them increase revenue in their businesses. So in 2019 already, we took a huge focus in our capital equipment division, and we've expanded our team, we've expanded our sales team, and we can see from being quite dominant in the office automation and the rental market, that our capital equipment and specialized team has increased from 20% to 22%. And it's not because the rental business decreased, it's because they grew in order to support that. And we also seen an increase in business, and a lot of opportunities are presenting themselves. So asset finance is geared, we've got a strong team, we've got a strong pipeline, and we've got an incredibly strong client base in order to take us forward for the end of the 2020 year and forward into 2023, 24, 25. I think I've covered that. We're going to be diversifying our assets. We're also quite excited, which I think Michael will expand on, is that we're working with Nasira, which is a loan from the Dutch, in order to support youth and women and SMEs in the market, which is absolutely aligned to SASFIN's values and to be able to contribute to society. And that in order to create employment, which I think our country needs, is you've got to be able to support these businesses. So there's a lot of exciting things coming from asset finance, And we've got growth, we've got opportunities, we've got the client base, we've got the team. So yeah, we get to recover from these results going forward. And just to thank the board and our clients and our team, and we're ready to embrace the next quarter of this year. So thank you, everybody. I'm going to hand over to Michael.
Good morning, everyone. I've only got a few minutes and I've got quite a bit to get through, so I apologize ahead of time if I go a little bit over time. Just to wrap up the pillars, and then I'll talk to the group as a whole. The last part of the group is our business banking area. So in this area, which falls under the bank, we're really trying to transform the business banking experience of our clients. And we've built this Beyond platform. The platform now integrates Forex and business lending. So when Francois mentioned that all the business lending would be housed inside Capital, he was talking more towards middle-sized businesses in terms of the trade and debtor finance, and in terms of some of the term loans that we're doing out of SASFIN Capital. But we are building loans into smaller businesses and smaller loan sizes, which I'll go into a bit more detail a bit later on. And we're integrating foreign exchange, and we've built this digital platform. And we saw really the benefits of this in the last quarter of the year. And this area will fund working capital requirements of growing businesses in a different way. At the moment, this is what the trade and debtor finance refers to, which will be moved out of our out of this area of the bank under Capital, which will really become a division of the bank focused on debt, as opposed to its historic focus, which Francois touched on, which was equity. So the highlights are now that our digital business banking offering incorporates the mobile app, revolving business loans, which are gaining some traction, but we're in the very beginning stages. And obviously with COVID, we were quite circumspect in terms of growing that. We've integrated our Forex unit, which will result in a seamless client experience as well as some cost savings with the Forex and the transactional coming together. We've seen good client income growth off the back of Beyond. Our relationship with HelloPays is working really well. Trade and debtor finance, new client onboarding, and its credit performance, which is quite important to note, because when we had a difficult credit performance a couple of years ago, it really was in our trade and debtor finance business. But this business had a pretty good credit experience this year. We have raised more provisions here like we have across all our lending portfolios. But the real increase in our credit impairments actually was more in our asset finance business, which Linda touched on, which is a much broader spectrum of the economy. There you've got a full exposure to a wide range of businesses, as opposed to in the trade and debtor finance business, which is a far more targeted or specialized business. Scale remains a big challenge for this business, and that in part explains some of the challenge in our cost to income ratio. This business ultimately, as we digitalize it and we grow the distribution, that scale should start to come through, which should not result in a significant increase in costs. So just looking at the banking pillar as a whole in terms of performance, so our income is down 5%. That is due in part to lower loans and advances, even though our net interest income is slightly up, which Angela referred to, due to some margin improvements, as well as lower volumes in our foreign exchange business and some write-downs in negotiable securities that fall in the income line. And then we have got this huge increase in impairments. And Angela did touch on this. To have a coverage ratio of 8% on a loan portfolio where only 10% of that portfolio is non-performing, and there hasn't been a huge increase, demonstrates our view of what the future is likely to look like. We've got a coverage ratio of 2% on fully up-to-date. Our stage 1 loans are our fully up-to-date performing loans, and a coverage ratio of 2% over there where our historic coverage ratio was lower than 1%, demonstrates that we do expect to see increased arrears, as payment holidays from ourselves and the broader banking industry start to dry up, that should result in increased arrears. But if the arrears experience, which we are focusing quite a bit of energy on in terms of collections, if the arrears experience is slightly better than what we forecasted, then obviously this is unlikely to repeat and there might even be an unwind. If the arrears experience is worse than what we forecast in terms of our forward-looking measures, then obviously there will be more potential pain. But given the big increase in our coverage ratios across all of our stages and the whole book, we believe that we are appropriately provided. And then the costs are up here by 4%, and as Angela touched on, we've amortized and impaired quite a lot of our intangible assets that's come down on our balance sheets, and we've got the non-cash items relating to depreciation in terms of IFRS 16. So the core cash costs, if you want to call it that, salary and related costs are actually flat, if not slightly down. And in terms of the Prudential Authority guidance, there's no bonuses in our bank, within the bank. And for material risk takers, obviously we have considered bonuses in our wealth business, given the nature of that business and its performance. So the key areas of focus for our digital banking area is to enhance our features, to drive this integration, to fast track the additional credit capabilities, and then to start driving these synergies between capital and trade and debtor finance. So now just to take a group view, and now let me just start off with COVID, if you move to the next slide. Obviously it's been a very difficult year. Many people have lost loved ones, people have lost their livelihoods, businesses have failed. We've seen the recent unemployment numbers, and before we even think about the economic impact, this is first and foremost a real human issue. And our hearts, our prayers, our thoughts go to all those who've been severely impacted over the last few months. And the impact has been so different for so many people. And while there's been good which is coming out of COVID-19, that doesn't take away or should not for 1 minute undermine the real trauma that many, many people have faced. And our concern is for those individuals. We implemented a 5-point plan in the immediate aftermath of COVID-19, where we prioritized health and safety of not just our staff, of our all our stakeholders. We moved to a remote working capability very quickly, and still even today, under level 1 of the lockdown, we have very few people working at the office. And right throughout, from level 5 all the way down to level 1, we've offered all of our services, all of our products have been available, and we have learned a lot around how remote working can become part of our future of work. And I think that there's a big opportunity to transform what we've been doing, which can add a lot of value to ourselves, to the company, as well as to our people. We've surveyed our staff on different occasions, and for many, many people, the cost and time and complexity of travel to and from work within the South African context is just huge. And therefore there's a big desire from big parts of our teams for increased remote working. In this regard, we haven't renewed our Melrose Arch lease, which is where our wealth front office has been housed. They'll be moving into our Waverley office for now, as well as increased remote working. And our Waverley lease, which we're at the end of quite an expensive lease, which had quite big escalations, that comes to an end in April 22. And we won't be renewing that lease. We will most likely be reducing our footprints through incorporating a hybrid model of additional remote working, or increased remote working, as well as making a great work space available for our staff and our clients. And I think that that's going to be quite transformative, also in terms of our cost line and in terms of the way we engage. Obviously, financial stability at this time is very important. You will note the drop in loans and advances, which is a bit of a double-sided coin. On the one hand, we want to grow loans and advances. We want to support our clients. It's how we generate revenue in the banking pillar and the capital pillar by and large. But in this environment, we prioritized cash, and the demand did drop for lending as well. And especially because a big portion of our lending book is in asset finance. And if people aren't buying equipment, then you aren't going to grow your loans and advances. So our deposits grew. Our cash is in a healthy position, even stripping out our land bank exposure, which is quite a large exposure, which we have created a provision against. And our regulatory ratios, our capital adequacy ratio is strong. We have provided quite meaningful relief in the form of payment holidays to clients with exposure of 1.57 billion. Just to be clear, that doesn't mean we've provided payment holidays to the tune of 1.57 billion. Most of those payment holidays are to our asset finance clients with term loans, essentially, or leases, and therefore we've provided payment holidays for 3 installments. And that's been very welcome by many of our clients, and we're working closely with our clients now that those payment holidays are coming to an end, even though we are still able to provide some payment holidays. We've also participated in the government loan guarantee scheme to a limited extent. We were only part of the second round, and we have provided that to certain of our clients. We've had lots of engagement with our various stakeholders. We've had many, many webinars. We've made various contributions to support those most impacted by COVID-19, including to the Solidarity Fund. And we cancelled quite a bit of client entertainment. We didn't just, we channeled some of those savings into providing relief to our own staff, to schools, to children on feeding schemes, which obviously dried up when everyone was forced to stay at home. So we've done a lot in terms of supporting our communities. So if I just look at the prospects, there are really 5 areas I want to focus on, and I'll jump straight in if you go to the next slide. So I've touched quite a bit on the future of work, and I think that what we've done in terms of digitalization, clients can onboard fully, with all our paperwork is now digital. Well, almost all our paperwork, and where it's not digital, we are looking to digitalize it. Clients can access their accounts, they can transact. Our internet banking capabilities are strong. We've got the mobile app, and that's transforming the banking experience, which will also allow us to optimize our service delivery and cost base in the future. And we will continue to invest and to fast track our digitalization efforts, which is obviously very important. And in business banking in particular, the digital banking, I suppose, has become a very hotly contested space. But our primary focus here is on digital business banking. And that doesn't mean that individuals can't benefit from that experience, but the platform has been built for businesses. So by integrating the payroll, the accounting, invoicing, working via direct APIs, which enabled, for example, our Hello Payza arrangement. We're looking at other alliance relationships. That is transforming the banking experience of our clients. But we also recognize that many businesses, have a specific need. They've got a unique need. And when you digitalize it, it's quite difficult to tailor a need. So we're not talking about digitalization, which is at the expense of a human engagement model. It's rather in support of it. And I think that if you look at, from my perspective, on the digital business banking where we compete, you get the digital business banks, but they tend not to be able to support their clients with high touch requirements. And then you've got high touch capability banks, if you want to call it that, who don't have the digital arsenal, which I think the real trick is in getting the correct combination. I've touched extensively about the future of work. So there's a big focus on streamlining our business. So we're seriously considering closing our Hong Kong operation and to run our offshore trade finance from South Africa. That business is contracted, and the expense and the capital that we have housed in our SASFIN Asia doesn't seem to justify running that business offshore anymore. And so that we're looking at quite closely. As Francois touched on, we focus on exiting non-core activities. We've done quite a bit of that already, and we continue to do that. Many of these non-core activities have high cost-to-income ratios. They are capital intensive in the form of the private equity investments. And by exiting it, we will streamline the business, we will reduce the complexity of our business, and we will release some of this lazy capital, which we can then redeploy into driving our lending activities, which I think is really where we need the scale. And then you can start focusing that capital to drive the scale required. And we are integrating the team. So Francois touched on how we're integrating the trade and debt finance and capital teams. I mentioned how we're integrating our Forex, so we've integrated our Forex and transactional banking teams. This means that we are building our units around our clients, which will benefit the client experience and will help us increase our scale and reduce some duplication and costs. Then we're very focused on supporting SMEs, and I'm very, excited and proud to announce, Linda touched on it, a 1 billion rand partnership with the FMO. The FMO is the Dutch Development Bank, and this partnership is to grow SME lending. It's made up of two different facilities. The one is a term facility of 390 million rand, and the other is a $35 million, call it a 600 million rand loan guarantee facility, where the FMO, really off the back of the ECB, will guarantee, we will carry a first loss, but they will guarantee a large second loss of the credit, which will enable us to scale up lending to smaller businesses, specifically women, youth, migrant, and COVID-19 impacted businesses. In the South African context, that's many, many businesses, especially the COVID-19 impacted businesses. And we will launch this to market in 2021. It enables us. I think there's a lot of talk in the media around the government guarantee scheme, which I think has played an important role. And as I say, we participated to a small degree, but it's not something which the banks can turn into a commercial business, because the banks take the first loss and there is no real profit capability for the banks. Over here, we can make a decent return, and we've got some credit mitigation, and that means it's a much more sustainable or viable offering which can scale over the long term. And we're very proud to be the first South African bank, the only South African bank at this point to offer the solution. And I think it will really enable us to strengthen our lending into smaller businesses, which this country clearly so desperately needs. We also continue to develop our lending capabilities in asset finance and SASFIN capital, which has been touched on. We'll do this obviously while taking a prudent approach to credit, especially in the very near future, given some residual uncertainty. Long term, this is more a long-term issue. It's not something which is going to happen overnight, but long term, our scale is really a function of our ability to generate a lower cost of funding. By generating a lower cost of funding, our net interest margin is healthy because we're able to obtain a slightly higher margin in our lending, given the risk that we're willing to take. But ultimately, real scale will be a function of our ability to generate a steady flow of deposits and ultimately transactional deposits. We are seeing these transactional deposits grow off the back of our digital banking capabilities. That enables us to increase our lending activities because we can then sharpen our pencil a little bit in the way in which we price our lending, which means that there's a bigger universe that we can lend to. We've got more funding available to do it and improve our margin. So this is a very important long-term aspiration, and that is the reason behind this heavy investment into our digital banking. And then Errol touched on SASFIN Wealth. It really has been, this business has achieved so much in the last few years. And we're still not yet getting the full benefits of what this business has achieved, because the 3% income growth that was generated in SASFIN Wealth is disguised slightly, because as Errol mentioned, we saw really good income growth, well beyond double-digit income growth in our foreign income and our institutional asset management business. And those businesses have got behind them strong investment capabilities, strong distribution capabilities, and therefore we don't see any reason why we can't continue to drive good income growth. the reason why the total income growth is only 3% is because of the continued drag of local markets, the local brokerage, the local management fees. But that drag eventually, as the foreign income and the institutional asset management income becomes more dominant in the total wealth income line, that then starts to create almost like if you want to call it, a Jaws effect in the income line, because at the moment you've got the one income stream dropping and the other income stream is not yet fully being, the growth is not yet fully being experienced. So as Errol touched on, people across the whole business is very important, but obviously in a wealth and asset management business, it's an IP business, and therefore we are building a business which can attract and retain top talent in the industry. We continue to grow our distribution team, which really has grown in the last couple of years, and that generating really good net new flows, and our investment offering further. And we're really excited about the wealth business. It's obviously, in this year, it's been a very important business for us, but I think that we're still at the beginning of this journey because of the pivot that we've gone through in this business. It's a completely different business to what it was 7 or 8 years ago. So just another point which I want to mention, which isn't on my slide deck, is that we put out another cautionary announcement just before we release the results, that we intend buying back our preference shares. That's obviously subject to a regulatory approval as well as approval from the preference shareholders and reaching agreements on pricing. We haven't declared final ordinary and or preference dividends given the losses, and the ordinary dividends, the guidance from the SARB. These are non-cumulative, non-participating preference shares, and therefore they don't attract dividends in the event of losses. Obviously, we did declare interim preference and ordinary dividends earlier on in the year. The loss for this year really is a result of two big factors. One has been this large write-down in our private and property equity valuations, and the other is this big increase in our credit provisions. And those both take into account forward-looking factors. So assuming our forward-looking assumptions, which include lower GDP, lower or higher unemployment, are correct, then we don't expect those shocks to recur. There are other shocks that could happen in the system, in terms of COVID-19, and there remains uncertainty. So I say that statement with a degree of caution, but ultimately our core income has been strong in the last period. As I've touched on, we're fast tracking the digital transformation, our capital is strong, and we are looking, and I think there are big opportunities to enhance our capital further through the streamlining of our business that I touched on earlier, which means I think we'll be in a good position to grow not just organically, but acquisitively, and we are looking at various things at the moment, early stage, so it's not worth spending too much time on. And, obviously our country faces big challenges, and the road ahead will be a very difficult road. And, we are very focused on living our purpose, which is to support the entrepreneurial spirit and the investment goals of South Africans. Those are the two key stakeholders which are at the forefront of our economy and the growth that the economy needs, and that's where we're very focused. In conclusion, I'm not sure if there are any questions, and we are well over time, so I apologize. But just in final conclusion, I would like to say a big thank you to all of you for joining us this morning, as well as to our board, to our management team who've had to work under very stressful circumstances, our finance department in particular. Running a year end in this kind of environment is challenging, and they've done an excellent job, as well as our total team, who really have had to adapt the way they work, the way that they operate, and have ensured high service levels, as evidenced by being recognized as the top advice broker, and the growth in new accounts in our business banking area. To thank our clients, to thank all our other stakeholders, our funders, our depositors, our regulators, our auditors, and we hope that we will be in a position to share good news with our shareholders and all of our stakeholders in the coming reporting periods. Thank you. I'm just going to stay on the line just to check if there are any questions. I don't see. Okay, I see one question. There appears to be a large portion of assets held in cash or short-term assets. What has been done to mitigate the effects of lower interest rates on income for the year ahead? Thank you. I think that's an excellent question. Obviously, in this environment, we have prioritized cash, and that will come with a bit of a negative carry. And that's going to be compounded to a slight degree by some of the new funding that I touched on. But ultimately, we want to get back into lending. That's very important to us. And as certainty comes, well, the uncertainty reduces, we need to get back to lending. And Francois touched on his pipeline within the capital and the trade and debtor finance areas. Linda touched on her pipeline, and we are building this lending capability for smaller businesses. So that's the real focus, is to focus our funding on lending. And then, as I touched on, we are also looking early stages at acquisitive growth opportunities, which could also result in increase in loans and advances. Early stage engagements at this point. So we're happy to, I suppose a bank has to choose between sleeping well at night and eating well. In the aftermath of COVID, we chose to sleep well by increasing our cash position. But you have to get that balance right, and we will want to grow our lending at the right moment. These are difficult engagements. If any of our shareholders would like to engage with us after the call, they are welcome to reach out to us, and we'll be happy to engage. They're difficult because of the remote nature of them. As I mentioned, all the information is released on our website, and you're welcome to glean through that information. And I thank you all, and have a good, enjoy the rest of your day, and all the best for the balance of the year. Thank you.